Good afternoon and welcome to the fifth installment of the First Citizens Asset Management Limited 6-Step to Financial Freedom Program. Again, I am Nadira C. Prasad, the Senior Marketing Officer at First Citizens Asset Management Limited, and I will be your facilitator for today's webinar. The aim of this 6-session program is to build investor confidence through a series of financial literacy webinars which shall encompass both savings as well as investments. The program is not designed to only promote the products of First Citizens, but created also to educate and inform the public of the need to take control of their own finances. First Citizens Asset Management Limited started its financial literacy drive in 2005 through hosting a series of seminars throughout Trinidad and Tobago, and the program has grown to now include personal meetings with corporations and now the newest edition, financial webinars. Just to recap the previous sessions, for those of you all who were there with me, Session 1 focused on the fundamentals of savings and investments. Session 2 gave a better understanding of risk. The third webinar gave financial tips on financial planning by life stages. The last webinar focused on credit management, and today's webinar will be looking at understanding your investments, namely fixed income funds, income and growth funds, as well as deferred annuities. Today's webinar will be 30 minutes in length with 20 minutes presentation time and 10 minutes to answer any questions submitted. To submit questions, please type it into the question window in your control panel. This can be seen to the right of the viewing window. If you do not see your control panel, please click on the red arrow to expand. Questions will be addressed at the end of the session. 2 polls will be conducted during this webinar. Please keep your viewing panel open after selecting your poll choice. I would also like to advise that all attendees will be in listen-only mode for the duration of today's webinar in order to ensure a smooth flow as the time is limited. This webinar is for informational purposes only. The investments mentioned may not be suitable for all investors. Please be advised that all investments do involve some degree of risk. When making any decision, you need to take your own financial situation and risk tolerance into consideration. Before making any investment, you are advised to read a prospectus. And to today's webinar. At the end of today's webinar, you will be able to understand the different products offered at First Citizens Asset Management Limited. Again, as I said, we are going to discuss fixed income funds, income and growth funds, as well as the deferred annuity product. Understand which product is best suited to which financial goals. Fixed income funds. Fixed income funds invest solely in fixed income instruments, namely bonds and certificates of deposits. Fixed income instruments do not mean that the amount paid will be fixed, but the frequency of the payments are fixed. It is a common misconception within Trinidad and Tobago that fixed income funds means that there would be a fixed interest rate or a fixed value being paid. However, fixed income does not refer to the value or the percentage that is being paid on the return, but it actually refers to the period. For example, you have monthly fixed income funds, you have quarterly fixed income funds, and as we said, it invests namely in bonds and certificates of deposits. And as we all know, bonds pay primarily semi-annually, which is every 6 months, so you know there's a periodic payment. Certificates of deposits can make their payments monthly, quarterly, semi-annually, or even annually. So these are the types of investments you would find in fixed income funds. Fixed income funds can be both long-term or short-term. For those of you who are not aware, right within First Citizens, we have a short-term, 2 short-term fixed income funds, as well as 1 long-term. We have the Abercrombie and Paria, which are monthly fixed income funds, and we have the Altacouch, which is a quarterly fixed income fund, which is actually geared towards medium to long-term growth. But we'll discuss the differences a little later. Fixed income funds can pay either interest or dividends. I'm sorry about that typo. It's supposed to be or dividends, but payments are set periodically, not by value. For example, some of you may be aware that within recent times, RBC Royal Bank has changed how their monthly fixed income worked, whereas there's no longer an interest rate tied to their fund, but rather now it works with a fluctuating unit price, so you have the opportunity for capital appreciation as well as dividends. So in that way, you see that fixed income funds can be either interest bearing accounts or they can be dividend paying accounts. Fixed income funds do not include equity investments, and this is one of the main things you need to remember when you're considering fixed income funds, because fixed income funds fall on the lower side of the risk scale because they are not exposed to the equity market. It includes bonds, certificates of deposits, corporate paper, municipal bonds, but it does not include any equity investment, so there is no exposure to the stock market. And for that reason, you will notice that the rates of return on fixed income funds tend to be lower than that of income and growth funds or even growth funds or pure equity funds. Within First Citizens Asset Management Limited, we offer 3 fixed income funds: the Abercrombie Monthly Fixed Income Fund, the Paria Monthly Fixed Income Fund, as well as the Altacouch. Now, the Abercrombie and the Altacouch Fixed Income Fund are both TT dollar denominated. So then again, some customers ask, what is the difference? Why is the Abercrombie giving a yield of 2.15%, whereas with the Altacouch you are getting quarterly dividends and a capital appreciation attached to it? Well, the Abercrombie is geared towards short-term returns, meaning that the Abercrombie, yes, it invests in bonds, treasury bills, and certificates of deposit, but the majority of the investments would be in the shorter term. So there'll be a small portfolio of bonds and a large portfolio of treasury bills and certificates of deposit. Whereas the Altacouch, which is mimicking a bond fund, it's designed to mimic a bond fund, will have a very large portfolio of bond investments and a smaller portfolio of treasury bills and certificates of deposits. And for that reason, the Altacouch will be for those seeking medium to long-term growth, and the Abercrombie is there for those who are looking for short-term, case of emergency, collateral for loans, that sort of thing. The Paria is basically the U.S. version of the Abercrombie. It's a short-term fund. The rate currently 1.40%. It is U.S. denominated. You start with a minimum of 100 U.S. The Abercrombie starts with a minimum of 500 TT. The Altacouch, you start with a minimum of 10,000 TT. And now, guys, it's on to our first poll. Do you believe that sufficient and accurate information is given by bank staff about investment products? Do you believe that sufficient and accurate information is given by bank staff about investment products? Please select yes or no, and again, I advise that you keep your viewing panel open after selecting your poll choice. And moving on, income and growth funds. The name says it all actually, income and growth. Income and growth funds have a dual strategy of capital appreciation, that is a growth aspect, and current income generation through dividends or interest payments. An income and growth fund may invest only in equities or a combination of stocks, bond, and other securities. Income and growth funds can actually be skewed more towards growth, more towards income, or it can be a balanced portfolio. Income and growth funds will give you exposure to the bonds because bonds are income streaming instruments. It will also have stock exposure because stocks is where you would get your capital appreciation, your growth. You would go into stocks in the emerging markets and so on. So in this way, you have a balanced portfolio, because what you will see with income and growth funds over a longer period of time is that they will outperform the fixed income funds. For example, in times when the interest rates are low, as we have seen recently in Trinidad and Tobago, the bond portfolio of the income and growth funds have actually been performing, and it has performed so well that it has covered some of the losses made on the stock exposure end. Whereas when the economy picks up again and the bonds start to stabilize in their returns and it's not as fantastic, the market value isn't as fantastic as it is right now, that's where the stock returns will start to pick up and give it a very balanced portfolio. So this is actually created to cater to the balanced investor with a moderate risk appetite. These funds typically outperform income funds because, as I said, the fixed income funds do not have any exposure to the stock market, but at most times they yield lower returns than the pure growth funds because the pure growth funds are greater exposure to the stock market and they focus only on the capital appreciation and the growth end with very minimal exposure to bonds, certificates of deposits, and that sort of thing. Within First Citizens Asset Management Limited, we actually have just one income and growth fund, that is the Immortal Income and Growth Fund. The one-year return on the Immortal Income and Growth Fund as at the end of August, that's August 31st, 2011, is 6.91%. So again, you see that these funds really, in the long term, will outperform the fixed income funds. The Immortal Income and Growth Fund at First Citizens Asset Management is actually very balanced in that we try to keep the percentage of bonds and the percentage of equities to match each other. For example, right now there's a little, probably around 40% in bonds, close to 40% in equities, and 20% in cash and cash equivalents to maintain liquidity. So it's a very balanced portfolio that we have. Deferred annuities. A deferred annuity is a tool popularly used for retirement planning, and it works in two phases. There's a savings phase where you make contribution and you continue to accumulate your capital, and then at maturity there's an income phase where your deferred annuity is converted to an annuity and you receive payments, which you would know as your pension. Deferred annuities allow for capital accumulation without earnings being taxed. Right now, you can contribute as much as you like to deferred annuities, and the interest that you earn on your deferred annuities are not taxed. Within Trinidad and Tobago, funds are taxed only if the account is closed prior to maturity, and this is for approved deferred annuity plans. If it is you decide to close your account prior to maturity because you received a tax deduction of 25%, BIR, that's the Board of Inland Revenue, will now in return tax you 25% of the value of your account if you decide to close it before maturity. Locally, there are no allowances for withdrawals from approved deferred annuities prior to maturity. So if it is you wish to have part of your contributions from it, you will have to actually close the account because we do not allow for withdrawals. And again, we are referring to the approved deferred annuity plans which are offered by the commercial banks as well as insurance companies within Trinidad and Tobago. This does not apply to the unapproved deferred annuity plans. Contributions to deferred annuities are tax deductible up to $30,000 per annum. What I would like to stress at this point is that $30,000 actually refers to contributions to all approved deferred annuities, all approved pension plans, 70% of your NIS contributions, plus any contributions to, I believe it's the Widows and Orphans Fund. So all of those contributions are lumped together, summed together in one area in your tax return to make up that $30,000. So you can actually look at how much it is your contribution to your company's pension, how much your 70% of your NIS is, and see how much room you have to get this tax deduction. For every $100 that you contribute to a deferred annuity, that is a $25 deduction in your PAYE, providing you remain within that $30,000 deduction. At maturity, at least 75% of the contributions must go towards the purchase of an annuity, a pension plan. You are being given this tax deduction to save towards the purchase of a pension plan. So at maturity, it is stipulated by law that at least 75% of your contributions must go towards the purchase of an annuity. There is the other option where, well, if you put 75%, that means that you can take 25% of your contributions plus part or all of your interest earned in a tax-free cash lump sum, or 100% of your contributions plus all of the interest earned can be used towards purchasing an annuity. There is no way to determine which would be better suited for you. At maturity, you need to actually look at what income you already have in place, what savings you already have in place, what insurance you have in place, because at times it may actually be better for you to take the 25% contributions plus the 100% of your interest tax-free lump sum and put that in an income-bearing mutual fund or an income-bearing investment product where you can at least maintain the capital, so in the event of an emergency you have something that you can touch. But it all depends on your own situation at your maturity. You can also have more than one deferred annuity product, and you can have it with different maturity ages. For example, if I had a kid who would be graduating high school when I am 55, I can actually have a deferred annuity to mature when I am 55, and I can use those, and I can then purchase a 5-year annuity plan, so I get a pension for 5 years every month, and I can use that to supplement the living expenses and tuition expenses and so on for that kid. Or I can decide that it's for me, and I can have another deferred annuity maturing at age 60, and that can actually be the larger deferred annuity because it's really geared towards my retirement. So these are things you can consider, and you can speak to your financial advisor or the person in the asset management companies of the commercial banks where you bank and find out what options are available for you. Because yes, deferred annuities are popular for retirement planning, but seeing that it has so many variances about it and so many uses, you can actually set up more than one or optimize the use of it not only for tax deductions but for future plans as well. Deferred annuities offered by commercial banks are defined contribution plans. I'd like to stress on this because we have many clients calling asking, is there a way for you to give me a projection of what my pension would be like? Only with a defined benefit plan where the benefit is already defined, predetermined, would someone be able to tell you what your pension would be like. However, with a defined contribution plan, the income phase, remember we spoke that deferred annuities have two phases, the savings, the accumulating phase, and the income phase. With defined contribution plans, the income phase is totally dependent on the performance of the investments while you held the accumulation phase. So it really is dependent on how well the deferred annuity performs, how much you've accumulated during that time, and the lump sum you then have at your availability to purchase your pension plan. So with defined contribution plans, there's no way for us to give you a correct projection of what your pension would be like. We can give you a projection of how much you may accumulate, but again, these projections that are given by insurance companies as well as commercial banks are based on an interest rate that is not guaranteed, and you need to remember that. So you need to know that even though I have this projection in hand at maturity, that may not be the amount I may have. So you may need to do other things. One thing I would like to also say about retirement planning is that the deferred annuity and pension plans are not the only products suited. The income and growth funds are very, very suitable for retirement planning. We spoke about the Immortal, and as I said, the 1-year return on the Immortal as at the end of August was 6.91. The interest rate declared on the retirement provider, which is our deferred annuity for the year 2010, was 4.5. So there again, you see that having income and growth funds as part of your entire retirement portfolio can actually help boost your portfolio. And now, guys, it's time for a second and final poll. Would you like to be able to get retirement planning advice at your bank? Would you like to be able to get retirement planning advice at your bank? Please send yes or no. Again, I advise that you please keep your viewing panel open after selecting your poll choice. And moving on, as we're coming near that 20-minute period that's supposed to be presentation time, preparing for retirement, these are just some quick tips. Start saving, continue your savings pattern, and stick to it. One of the problems I see with many clients is that they come to my seminars, listen to my speeches, they meet with me one-on-one, they open these accounts, they say, yes, Ms. Sipasad, I'm ready to start saving, I believe we can do it. They open the account, they make contributions for 1 month, 2 months, and I don't see them after that. When you start a savings plan, you need to continue with that savings pattern and stick to it. If you do not stick to it, you will not achieve the goal that we had in mind. And you will find that later on, when the time comes around or when you get closer to retirement, you start to wonder, how am I going to survive? Because if you remember, your salary is going to be cut drastically when you get your company's pension. the maximum pension you will receive is 2/3 of your salary. You need to save with a goal. You need to know your retirement need. You need to determine, for those who are the medium to higher income bracket, we advise 70% of your pre-retirement income is what you should be looking at as your income after retirement. And for those in the lower income brackets, we advise 90% of your pre-retirement income should be your income at that time. So you need to have a goal in mind. You cannot say, okay, all I can afford is $100 a month, because it may not be able to meet your goal, and sometimes we may need to rearrange your expenses in order to have you meet these goals. You need to learn about your employer's pension plan in order to determine if there's any shortfall in your retirement need. So when it is you determine how much it is you need at retirement, and you then understand your employer's pension plan and you have an idea of what your benefit would be, you would then be able to identify if there's a gap and how much it is you need to now put aside and have your own individual retirement plan for that. You need to expand your investment horizon to include investments with stocks and bonds to provide a hedge against inflation. You need to recall that whatever your cost of living is today, it will not be your cost of living at retirement. For those of you, if you recall, the cost of bread, milk, all the basics that you needed 10 years ago as opposed to now, think of what it's going to be like in 20, 30 years when it's time for retirement. So you need to actually open up your risk appetite and now include products that have exposure to the stock and bond market to provide you with a hedge against inflation. And this is why I spoke about income and growth funds being a valuable part of a retirement planning portfolio. I know that I'm going above my 20 minutes of presentation time, but this is the final part. The product we are featuring today is a retirement provider. That is a deferred annuity offered at First Citizens Asset Management Limited. There's a minimum monthly contribution of $100. There's no maximum contribution. Payments can be made monthly, quarterly, semi-annually, annually, or in lump sum payments. If you do not make your payments, there is no charges. There's no lapse on the account. You can start back. If you're unemployed for a year or 2 years and you're unable to make payments, that is okay. You simply continue when you can make payments again. There are no charges if you miss payments. There's a free life insurance attached to the retirement provider. It matches your scheduled contribution up to a maximum of $150,000. There are two options at maturity. We spoke about those two options. You can have 100% of your contributions plus all interest earned used towards the purchase of a pension plan, or 75% of your contributions goes towards the purchase of a pension plan, and you can receive 25% of your contributions plus part or all of your interest earned as a tax-free cash lump sum. So that is a product we had featured for today. And now I will address any questions that you all may have. Okay, I am seeing one question here. What is the initial deposit for the Immortal Fund? The initial deposit for the Immortal Fund is only 500 TT dollars. 500 TT. I'm seeing, is there an allowance to withdraw from the retirement provider for the purchase of your first home? That allowance has actually been removed. I believe it was in 2005 that allowance was removed because there was a restructuring in the tax regime. I am also being reminded that I should share the poll results, which I normally forget to do. Okay. For the first poll, I'm seeing 30% said yes, 70% said no. For the second poll, %96 said yes, they would like to receive retirement planning advice at their commercial banks. That is something we can actually look into at First Citizens. Is the Abercrombie Fund as well as the Immortal Fund covered by deposit insurance? Unfortunately, no mutual fund within Trinidad and Tobago is covered by Deposit Insurance Corporation. Deposit Insurance Corporation, as the name says, covers deposit accounts only. That is your regular savings account, regular checking account, certificates of deposits. It even covers things like your manager's checks and so on, but it covers no mutual funds. Can the CSV of the Immortal Fund be used as security or collateral? All of the mutual funds at First Citizens Asset Management can be held as collateral for loans. The Abercrombie Fund, 100%. The Immortal Fund, the Eltakuch Fund, and the Paria Fund are all margined at 80%. Any mutual fund with a fluctuating unit price is margined at 80%. Any mutual fund that is in a foreign currency is also margined at 80%. What types of investments would you recommend for a 25-year-old with $15,000? I would be unable to answer that directly because I would need to look at the financial situation of the 25-year-old, see what they already have in place, see what their goals are, if they're still studying, if they have a family, if they plan to have a family soon. So I can't give financial advice without looking at someone's current financial situation. Will I get back any money if the bank closes down and my contribution to the Abercrombie is still there if I don't have? First Citizens Asset Management Limited accounts are separate from the bank. First Citizens Bank is separate from First Citizens Asset Management Limited. I think your question is, if something happens to First Citizens Asset Management, will you get back your money? If the fund crashes, if any mutual fund crashes, there is no guarantee that any payments will be made. Your capital is not guaranteed, your interest is not guaranteed, there's no guarantee on any mutual fund by Deposit Insurance Corporation. However, what I would like to stress at this point, with the mutual funds with a fixed unit price, your capital is not affected while you hold the investment. The Abercrombie unit price is $20 TT. You purchase at $20 TT, you redeem at $20 TT. So even though the interest rate might be low, just 2.15%, your capital has not been affected because the unit price stays the same. However, with the Immortal and the Eltakuch, where the unit price changes on a daily basis, there is no assurance of your capital because your capital value changes as the unit price changes. But with the Abercrombie and the Paria, your capital value does not change because the unit price does not change. Nearing the age of 40, should I lessen my risk investment efforts and focus primarily on retirement? I normally say about 5 to 7 years pre-retirement, you need to look at moving your investments from the higher risk portfolio to a lower risk portfolio. Because as I say, you don't want to find out that if you had a retirement nest egg of $2 million when you're 45 and you retire at age 50, that $2 million is now worth just $1.6 million because you left it in the high risk investments. So 5 to 7 years pre-retirement, you need to start moving it a bit at a time. Not all at once because you still want to maintain a part of your portfolio to hedge you against inflation, but you need to start moving over some of your investments to the safer end, in fixed income funds, the certificates of deposits, irregular bank accounts, treasury bills if you can, that sort of thing. Is it wise to take a loan above $30,000 to invest? Again, this really depends on you. There are some people who really do not have the discipline to save on their own, because normally I don't advise on a loan to invest because the interest you're paying the bank is higher than the interest you might be earning on your investment. Because if it is you took a $30,000 loan to invest in the Abercrombie, you're earning 2.15% on your Abercrombie. However, you may be paying as high as 9 or 10% on that loan, which means it's really negative returns for you. However, if it is you know that this is the only way you can save is through a forced savings plan, then I will advise yes, because it's always advisable that you have some sort of savings plan. So really and truly, I would prefer if you start doing the savings on your own, because if it is you can afford to pay $500–600 in a loan payment, you can put that $500–600 towards a savings plan instead. But if it is you don't have that discipline, but if you took a loan, then the deduction for the loan payment will be automatic from your salary and you'd see a savings there. If that is your only option, then yes, I would tell you go ahead with it. But you really need to look at what interest you're paying on your loan, what interest you're earning on your investment. How do I make an appointment to discuss investment possibilities at First Citizens? You can send an email to investments@firstcitizenstt.com. My email address is also nadira.cipasad@firstcitizenstt.com. My extension at First Citizens Asset Management is 2424. The telephone number 623-9092, extension 2424. nadira.cipasad@firstcitizenstt.com, or you can send an email to the entire department, investments@firstcitizenstt.com, and someone will respond to you. The thing is, you will not have to come into our office in Port of Spain. We will meet you at a branch that is convenient to you, or your workplace if that is convenient to you. And sorry guys, but we are out of time. I have crossed my 30 minutes. Thank you so much for being with me. In the next 2 weeks, October 5th is actually our final session. It will be an overview of everything that we have discussed. So we'll do an overview of investments versus savings, credit management, understanding risk, as well as retirement planning. We're just going to touch on each topic briefly, and I will be welcoming any feedback from you during that session. Thank you again, and have a good afternoon.